Welcome to It Depends, a sales tax podcast by TaxConnex. I'm your host, Brian Greer, joined by my colleague, Jeff Meggs, and we're super excited that you've joined us today. Sales and use tax can be confusing and overwhelming, but it doesn't have to be. Whether you work in an industry or a CPA firm, or just someone who wants to stay informed about the latest sales tax laws, we've got you covered. Periodically, we'll explore different aspects of sales tax. So whether you're a tax pro or a novice, in industry, school, or a practicing CPA, tune in and join us as we attempt to simplify the complexity of the sales tax world. This is It Depends, because with sales tax, there's rarely just one answer, and often that's our answer to many questions. It just depends. The bulk of what we're going to be talking about today, going to spend a good bit of time on Sales Tax Nexus. I'm sure the concept in general is very familiar with everyone, but we'll talk about it in a little bit more detail here. Also talk about the taxability of products and services across the different states. And we'll have a kind of a sprinkling of compliance activities as well in terms of registration and ongoing compliance activities. But let's get started.
You know, when we think about sales and use tax in the context of a multi-state environment, one of the first things we always address is Nexus. Nexus is basically that level of presence that somebody has with a state, and Nexus for sales and use tax purposes generally falls into a couple of different categories. So we're going to talk a little bit about the history of or evolution of Sales Tax Nexus first, and then we'll get into the more recent developments. And when I say more recent, things that have kind of transpired over the last handful of years. So to kind of go back in time to set the stage for how we established the baseline for Nexus for sales tax purposes, we go all the way back to 1967. There was a case, National Bellis Hess versus Illinois, and the state of Illinois had asserted against National Bellis Hess. And National Bellis Hess, by the way, was a clothing retailer, and they had catalogs that they would send into different states to prospects or individuals who could then call in or mail order from those catalogs clothing. The state of Illinois sought to assert that National Bellis Hess had Nexus for sales tax purposes based on the presence of those catalogs in the state, and served them notice that they needed to register and comply with the sales and use tax laws. National Bellis Hess challenged that theory, and in doing so, it went up through the Supreme Court, and the courts basically ruled that there had to be more than insignificant presence. There had to be substantial presence. And in making that sort of statement and ruling, they kind of laid out the categories that would represent or reflect of legitimate physical presence. And in that regard, things like having an office, having employees resident in the state, and then having inventory in the state. These were things that were very commonplace in the era of 1967 that would be logically a physical sort of presence in a state. Things that kind of ancillarily came into play with regard to physical presence were things like a traveling sales rep. So maybe the sales rep doesn't live in the state, but they're directed to visit the state to solicit on behalf of a company. So they're spending a bit of time. Generally speaking, when we look to evaluate that activity, we're talking about how many days did they spend performing those solicitation activities during a 12-month cycle. And it's that number of days or the frequency of that activity that tends to drive whether or not they've met a threshold standard for sales and use tax purposes. Now, the reason I haven't told you the number of days is because the states don't really tell us the number of days. And so there are some states, Michigan is an example of a state that says once you've had 2 or more visits in the state, you've now established Nexus for sales and use tax purposes. But the majority of the states were never really clear about the frequency and level of that activity that would trigger Nexus. They only would tell you that a significant level of that activity would be deemed to create Nexus. Similarly, we would see trade show activities. And when we talk about trade show activities, we're talking about sending representatives to a trade show to market, to display, to try to educate the market or establish a market for the products and services. This isn't me going to a trade show for training purposes, or if I've been asked to go to a trade show and speak as an industry expert. So trade shows kind of fit into the same category of traveling sales reps and solicitation. And similarly, you would have, again, number of days within a 12-month period. What's kind of interesting about trade shows is that the states soon recognized, or at least lobbyists recognized, that we can't curb trade show activity in our states. We need to encourage trade show activity. We want to bring people into our state for trade shows. And so some of the states do a nice job of stipulating how many days of those activities would trigger Nexus. California, for example, talks about 15 days plus a level of sales activity before you would trigger Nexus for trade show attendance. So those are sort of the common theories and common aspects of what we think about when we say physical presence. But there is one last category that I want to talk about that tends to catch people a little bit off guard. Brian and I have seen it time and time again in some of the speaking engagements we've done, and that is third-party contractors. And what I'm referring to here, just to use an example, is maybe I'm a copier sales company, and I sell copiers into a state, and I sell, in addition to the copiers, service agreements or maintenance agreements. And at a certain point in time, subsequent to that first sale of tangible personal property, I have an obligation to fulfill a warranty, a service agreement. And in doing so, instead of sending my own employees into that state to perform that service, I'm going to leverage a local resource that has the same specialty, same experience and expertise that they can bring, and I'm going to engage them to visit my client directly. They're going to go on site, they're going to perform whatever maintenance or service activity is required. My client will not really see that third-party contractor is in fact a third party. Now, they may recognize it as such, but in essence, what I'm doing when I engage that third-party resource is I'm establishing a physical presence. And so what we really are saying when we talk about physical presence is we're leveraging resources of the state. So if you look at each of these categories, there are resources of the state, of the tax-paying sort of people in that state that are allowing me to facilitate establishing a market. And if you're asking, well, what does that really mean? So a trade show, for example, there had to have been hotels built, there had to have been roads, there had to have been airports, there had to have been some way for me to visit the state. And that's infrastructure, and infrastructure costs money. Some of that's federal funded, but a lot of it's also state funded. So third-party contractors, my ability to leverage that third-party contractor is made possible by the fact that that state encourages commerce, encourages business. And so they've got the infrastructure to support that. And I'm leveraging that infrastructure. So I have to be a participant in the support of that infrastructure. That's the concept behind physical presence.
And Jeff, I'll kind of add to those third-party contractors that, because sometimes a separate question comes in regarding this, and the way I think about it is really you're utilizing somebody that's helping you satisfy a contract that you have with the client. So the client, in Jeff's example, bought the copier maintenance from the copier company, and the third-party contractor is fulfilling that contractual obligation. It's different than if I hire for my business a website developer to develop and modify my website. That's not the type of third-party contractor we're talking about here. It's someone that helps you fulfill your contractual obligation to your client.
Exactly. So we go from 1967 and National Bell Assess and sort of these standards to 1991, I think it was, might have been 1992, and we have North Dakota versus Quill. And in that scenario, North Dakota sought to assert Nexus against Quill, Quill being an office supply type business, mail order if you're not familiar with them, mail order, catalog type distribution. But what North Dakota said was that a lot had changed since 1967, and the marketplace had changed, and the way companies did business changed dramatically, significantly. And they sought to assert Nexus just based on those criteria or those tools that were being used, not the least of which were telephones. And so they were basically asserting physical presence in the way of leveraging telephone communications, which, if you think about it, isn't a bad argument. It's still leveraging the infrastructure of the state. There has to be telephone lines. There has to be freedom of communication for me to do business. So it was a pretty strong argument. The courts, however, ruled against them. I think there were several reasons why they ruled against them, but in doing so, they just kind of reasserted the physical presence test that we talked about just a moment ago. And so states from that point on started to get even more aggressive or creative, let's call it. As things started to advance technologically in our marketplace, states started to feel a little bit at risk for some of their more traditional brick and mortar revenues that substantiated or supported their sales tax base. And so we started to see different types of positions being taken by states during the 2000s and the early 2010s, one of which that was not very popular, but got a lot of press, was notification requirements. And I know I'm not going to be speaking to our slide in order of bullets, but this one always bothered me the most, so I tend to take it ahead of time. And example of this was Pennsylvania and Colorado did a little bit of this. Colorado is not our favorite state because they have a unique way of doing things and thinking about sales tax. They're also fairly complex in that they have a lot of home rule jurisdictions that impose sales tax. That being said, what Colorado required or sought to require from the outside the state commerce activity was a reporting requirement, meaning that at the end of each year, you had to submit to the state a list of all the customers that received products from your business. And in a lot of ways, I think initially at least, they wanted to know what kind of product did you sell to that customer, which clearly was infringing upon some privacy theories and laws. In addition to that, they asked that vendors from outside the state that didn't have a physical presence also include a statement on their invoices that told the consumer they had a requirement to self-remit use tax on those purchases. Now, they set some parameters in place to at least have some level of materiality threshold. I think at the time, this is going back now 15 years for me, so I might forget, but I think at the time it was very low, like $10,000 of receipts. So it was a very low threshold. And essentially what they were doing was trying to influence everybody into registering, because nobody, as we heard, as you personally were listening to me describe those requirements, nobody would find that reasonable, and nobody would set out to actually comply with that. So what they said was, well, in the absence of that, you can register. And so there were a lot of companies influenced by that chose to register. And I'm sure there were a few companies that started to comply with the notification requirements. But at the end of the day, there were some other states that kind of went down this path. It was just kind of one pathway that we saw. Another one that was fairly popular and started to get more and more momentum was what we refer to as click-through Nexus. And in this scenario, what basically the states were doing was saying, look, if there's an owner of a website in our state, and that website owner allows for an out-of-state retailer to have a link to their website through the in-state website in return for compensation, then that constituted a physical presence or what we referred to as click-through Nexus. And essentially what they said was, look, you're basically advertising on a banner within our state, leveraging a resource within our state, this being a website. So instead of a billboard, you're putting your banner on a website. And the fact that you're paying that website for sales, so if I actually achieved a sale through that website banner, that website owner would get reimbursed or compensated. You're leveraging an in-state resource for that benefit. New York was probably the largest state that went down this path. And it was a pretty big ticket item. I mean, it was a big deal. This was back in 2010, 2011, when this started to kind of gain momentum. I think there were maybe 12 states that adopted this same principle and started to get somewhat aggressive about it. There were some other things that were taking place at the time. Cookie Nexus being, that little piece of code that I think a lot of us probably experience when we're web searching for something, and we land on a website, and at the bottom of the website there is some statement about cookies being accepted or declined. And basically they're designed to create a better experience for me in a recurring fashion if I were to use that website often. But what the states sought was to assert that created a physical presence, because you loaded that software onto that local hard drive, and so now you have software in our state. You have a physical presence, and they sought to assert Nexus based on that. And other states had started down the path of an economic Nexus standard. In fact, the most successful of which I would say was Washington. Washington has a sales tax. They also have a business and occupations tax. The two are very well integrated, and Washington was very successful with their economic Nexus position, and they seem to have cracked the code, although I can't speak too broadly about challenges that would have taken place against them. They continue to be a little bit more on the aggressive side in this regard, in fact. But that economic Nexus theory started to have and gain momentum, and it did so at the federal level. The federal, I think it was Congress that was looking at some different bills during the mid-2010s to try to level the playing field, as they called it. They wanted to create a level playing field between the brick and mortar and the internet-based businesses, make it fair, and at the same time, and more importantly, I think for the states, make sure the states didn't lose any revenue as a result of it. So a lot of activity, a lot of things happening. And then in 2016, we have a big event.
Hey, Jeff, just a kind of a quick question on some of those unusual Nexus activities like the click-through Nexus and the cookie Nexus. Did those go away, or are they still around?
It's a good question, and if you'd have planted it between the next two slides, it would have been even better. But those have been repealed. So the notification requirements, the click-through Nexus, those have been repealed as a result. And when I say repealed, some of those may not have even been formal legislation, but they've been removed from the administrative policy or repealed from legislation since 2018.
Perfect.
So in 2016, South Dakota sought to change the world, I'll say. And in our world, we think sales tax is like very important and high profile. So when anything happens of this magnitude, we get all sort of nerdy about it. But this was sort of the biggest probably change in sales tax law that has ever happened in my career. And I'm old. I know you can't really see me on the screen here, but 34 years in sales tax, and this was a pretty massive thing. Basically, the state of South Dakota passed legislation that would require any company outside the state of South Dakota that generated more than $100,000 in revenue during a 12-month period, or had more than 200 transactions during a 12-month period, to comply with their sales and use tax laws. And when they enacted the legislation, they actually put in place a very efficient and deliberate sort of passage through the legal system for anybody that wanted to challenge this law. Because as you might imagine, this is sort of a big deal for a lot of states that were looking to kind of close the loop on losing brick and mortar revenues. And there's a lot of companies now at this point in 2016 that are operating almost exclusively via the internet in their retail activities. And so you can't leave all of those companies and all those states holding their breath, wondering, is that really constitutional or isn't it? And so eventually South Dakota asserts Nexus against Wayfair, Wayfair being a large internet retailer, home goods shopping type market. And Wayfair decides to fight the case. As you might imagine, there are all kinds of interested parties here. There are other companies that are actually supportive of South Dakota because they're in an unfair advantage with Wayfair. There are states that are supporting South Dakota, and then there's a bunch of companies supporting Wayfair. They don't want any part of this. This would be a massive imposition on their business. So this goes up to the state Supreme Court, and interestingly enough, the state of South Dakota ruled in favor of Wayfair. So yay, we all win. And we were kind of leaning on the fence on the side of Wayfair in some regards. But ultimately, the state of South Dakota enticed the U.S. Supreme Court to hear the case, and they did so. It was in April of 2018 that the arguments were heard. And in June of 2018, the ruling came down favorably and indicating that this was constitutional or did not violate the Constitution and interstate commerce. And so basically, the U.S. Supreme Court, in validating that South Dakota legislation, opened the floodgates, opened the doors for all the other states to enact similar legislation. And surprisingly, shockingly to all of us, that's exactly what happened. As you might imagine, actually, the states, I'm being sarcastic if it's not clear, the states were already in line. They already had written their legislation. They were ready to enact right on the heels of this decision, some quicker than others, but ultimately they all had a vested interest in this. So today, as we sit here in 2023, now we're quite a few years after this big change in theory. We have all of the states that impose a sales tax having their own economic nexus standards. And I'll speak to this in a kind of broad spectrum and then also paint some finer points for you. First thing I want to say is that there are 5 states that don't impose a sales tax. So when you look at our map here, you see a few gray states here. You might wonder, well, what's that about? Oregon doesn't have a state sales tax. Montana doesn't have a state sales tax. Delaware, New Hampshire, they don't have a state sales tax. Alaska, interestingly, is blue in our display, but Alaska doesn't have a state sales tax either. So why is it blue? Because there are cities in Alaska that do have their own sales tax. They self-administer. They have their own laws regarding sales tax. And so to the extent you have nexus in those cities, you have an obligation to comply with those cities' sales tax rules. So what happens is that the states all start adopting these rules. And what's interesting about it is they all sort of have the same feel of South Dakota. And they're so similar that the way I speak to clients and people that are trying to evaluate this and get their arms around it, I tend to just use that South Dakota rule of thumb. And really where I focus is that $100,000 threshold. So let's not make it more complicated than it already is. And let's just assume for now that every state has enacted economic nexus and they're all $100,000 thresholds. And generally speaking, that's a gross receipts threshold. And what you'll find if you start to drill down in each of these states is that there are nuances. Some states will say, only on tangible personal property sales do we want the gross receipts to apply. Some will say it has to be retail sales. It can't be gross receipts. There are a number of states that also enacted the 200 transaction rule, but a lot of them didn't. And then there are a few states like California and Texas that have a $500,000 threshold. There's a few with a $250,000 threshold. So there's definitely some variability in those sort of determinations or thresholds. But I encourage you, if you're at all concerned about that, start at that $100,000 threshold. It's a safe base. And then when you trigger the 100,000 or exceed it, at that point, look to be more granular about the understanding of what that 100,000 really means. And is it really 100,000 in that particular state?
Yeah, one of the things that I find interesting about this whole economic nexus piece, and if you really get into the court case, not that I'm an attorney by any stretch, but one of the premises that exists when the Supreme Court ruled in favor of South Dakota, having trouble speaking for some reason, was that there would be a small business exception, meaning that they did not want to impose these sales tax rules on quote unquote small businesses. A little bit of a gray area, but what ended up happening is over the last year, maybe year and a half, there's been a lot of emphasis on these transaction counts. Whereas you heard Jeff mention, most of them started out, if they existed, in the 200 transactions or 200 invoices in a 12-month period. We're seeing a lot of those starting to be repealed now. And I think the reason for that is that there's a lot of businesses that sell small dollar value but high transaction volumes. And it was never the intent to force someone that is selling $205 items to follow the sales tax rules. So it's to some extent in contradiction to what the Supreme Court ruled in favor of in terms of a transaction count tends to be a little bit in contradiction. So you've seen even South Dakota repeal their transaction count. I think there's a number of states, including I think California, North Dakota, Massachusetts. There's 8 or 10 that have repealed this. I think Louisiana is effective maybe July 1st of this year that they're repealing their transaction count threshold. So again, kind of all the more reason to pay attention to what Jeff said in terms of that gross receipts, that $100,000 sourced into a state. That's really kind of the factor that we like people to take a look at. So I think we're going to see more states remove those transaction counts as we go along here.
It's interesting because I think this is a true statement for everybody that's trying to manage their sales tax nexus footprint or just sales tax in general. And you're not living in it day to day like I am. What's interesting from my perspective personally, I love the economic nexus threshold. It actually makes things clearer for me. And when I say that, I don't mean that it's still not complicated, because it very much is. Now you've got to worry about all those different physical presence tests that we talked about earlier. Those did not go away. This was not a replacement strategy for the states. This was an enhancement strategy. And so those physical presence standards still exist, and they're important, and they come into play quite a bit. I was on a couple of calls this morning with clients, and it was a physical presence standard. And what's important about physical presence standard is you immediately trigger Nexus. What's different about economic nexus standards is you can be doing business for a period of time, and it's not until you eclipse a certain level of activity that you trigger Nexus. And it's not until then that you need to register. So in any case, it is complicated. But at the same time, again, from my perspective, it at least gives us a bright line test. It basically says, okay, how concerned should we be if we've only got $20,000 in revenue and we have physical presence? Maybe that doesn't encourage us to be compliant. And I'm not suggesting that you don't have to be compliant. I'm suggesting that you want to be compliant and be compliant when required. But I think we all struggle with that whole cost benefit. How much risk is there if I'm only selling $20,000 in 1 year? And I don't know if I'll ever sell into that state again. And once I register, I've got a filing requirement in that state. The flip side of that is if you're not careful and you take this sort of approach, you can easily and quickly get overwhelmed with it, because year over year that 20,000 accumulates. So first year it's 20, next year it's 50, still not feeling like I need to register. Next year is 50 again, next year is 25. All of a sudden you look back 5 years now and you've got $250,000 in taxable sales, and you had Nexus in all 5 years. You're exposed. the state can assess. And so it's a fine line to walk. And everybody's materiality thresholds are going to be different. Understood that. And anyway, I think just thinking about Nexus in this way gives you a little bit of an advantage, and hopefully gives you a little bit of peace of mind.
What does gross receipts mean? How's it defined?
Yeah, it's a good question. The way we would define it is it's the gross amount you have invoiced customers during that 12-month period or during that calendar year. That's how we would define gross receipts in general terms.
And I think you may have indicated in some of the states, the economic nexus measure, most of them it is a gross receipts measure, but some of them are a taxable sales measure.
Right.
Not a gross receipts measure, but the majority is a gross receipts measure.
Yeah, I don't know the exact split, but that's the way I tend to think about it, is the majority are gross receipts.
The $100,000 threshold we're talking about, is that in total sales to all states or into that specific state?
It's state specific. So it's once you've invoiced more than $100,000 into that specific state that you would find yourself subject to that threshold.
What happens, Jeff, when you eclipse those thresholds in a particular year? So now you register and start filing, and now the following year you're under the thresholds.
Yeah, and I have clients that'll ask me, can I go ahead and deregister or close my sales tax account? I just don't want to continue filing returns unnecessarily every month or every quarter. And the way I'd answer that question is, from a statutory perspective or a clinical perspective, you will find that from time to time you will phase out of Nexus. You will no longer have economic or physical Nexus in a particular state. And it's okay when that happens for you to close your account. Now, there's a couple of things to keep in mind. One is there's usually a theory that applies to a lot of states called trailing Nexus, meaning if you have a physical presence in the state, for the next 12 months after that physical presence, you continue to have Nexus. And what that is intended to cover is I might go visit that state in January, and I might make relationships with 5 different companies that I then foster from afar for the next 6 months or 12 months. And then towards the end of the year, I start landing deals. So there's this trailing expectation that I've kind of created a market that's beyond just that month in which I established physical presence. But it's okay to consider closing accounts from time to time. What I would not encourage you to do is get into a practice of opening, closing, opening, closing. That's going to probably give you some headaches down the road. It'll create some problems with your statute of limitations. You know, if you're filing regularly, the state's limited to how far back they can go to assess. If you start filing and then you stop and then you start again, you're breaking that link of the statutory limitation. Statutory limitation usually being 3 to 4 years. So it can happen. You can do it, but just be cautious about it. So as I was saying at the very beginning, we first try to ascertain whether or not Nexus exists. Do we have a physical presence or an economic presence within a state that would allow that state to enforce their sales tax laws on our business, on our transactions? If the answer to that question is yes, we have triggered Nexus, we then need to say, how would the state impose their taxing authority on us? In other words, what is it we do that might be taxable? And this can have some varying degrees of similarity across the states, except for one thing. The sale of tangible personal property, that's sort of the baseline for all the states when it comes to sales and use tax. The statutes will even start out by saying the sale of tangible personal property and enumerated services are subject to a sales tax. And tangible personal property is anything that can be seen, touched, felt, perceived by the senses is a lot of the ways they describe it, which brings into question a lot of different things. You know, I can't necessarily see, feel, or even touch or feel like I can touch air. So oxygen in an air tank, what is that? Well, it's tangible personal property. Electricity. I guarantee you we can all touch and feel that. So there's things that are tangible that might not otherwise feel like they're tangible. When we talk about enumerated services, there's a varying degree of sort of encompassed services that are taxed from a sales tax perspective. One of the things that we hear very commonly across the clients we talk to is, well, professional services aren't taxable. And the problem with that statement is that nobody really understands what a professional service is, and the definition of it could change or be treated differently or considered differently state from state. What I call a professional service is the practice of accounting, medicine, legal, architecture, and engineering. Those are the 5 core, what I call professional services. Those are generally required to have special licensing, they're very formal and usually educational accreditation. Beyond that, everything else in my context is consulting. And so any other service outside those core 4, I might call it a professional services just because it's a common phrase that means not taxable. But there's a lot of consulting services and other ancillary services that are subject to sales tax. For example, telecommunication services. Almost every state taxes in some form or fashion, some form or some type of telecommunication services. Installation services are commonly taxable. Shipping and delivery services, commonly taxable when they're associated with the sale of tangible personal property. Then you get into technology, and then technology, this is where I think more often than not people get surprised and they have a more difficult time managing to the rules of services. And what I mean by that is when you're selling technology, there's a breadth of activities that can be included in that. Primarily, we're talking about software. You know, in the old days, we were delivering software in a tangible medium. Today, we're very rarely doing so. We're usually delivering it via an electronic download, or it's a subscription-based or software as a service. So depending on the state, downloaded software can be taxable. There's a good number of states, in fact, that tax downloaded software. There's again, a good number of states, not as many, but a good number of states still that tax software as a service. And then you've got those ancillary services that come along with those products that involve implementation or configuration of the service. You've got maintenance agreements. Maintenance agreements can come in different flavors. They can be pure phone support. They can include upgrades or updates. And there's every state has unique rules around all of those different circumstances. A lot of times, if any of those services are mandatory as part of the purchase of the product and the product itself is taxable, then that ancillary service becomes taxable. So for example, I might sell support, pure phone support to someone in, I'm just going to make up a state, the state of New York, which does tax software as a service. And if it's mandatory, there's more likelihood that that support charge is also going to be taxable. If it's optional, meaning I can opt out, I don't have to buy it, it's not required, then it might be exempt. And I say might, I'm not giving you New York law in this conversation today, I'm just using it as an example. So a lot of unique rules and a lot of little criteria that you have to consider when you get into service taxability. You got a few states out there that tax services in general. Those would be New Mexico, Hawaii. Then there's a few states that are heavy on the service taxation. West Virginia, South Dakota. Most of the other states are pretty discrete about what's taxable on the service side. It's not as broad. So just something to consider as you guys start to expand into different states.
And Jeff, I'll add a couple of points here. When we've talked, you mentioned the SaaS taxability. We've obviously talked about Nexus a lot. We've got a couple of resources on our website where we've got a Nexus map, and it provides all of the different thresholds. It references whether it's a gross receipt state or a retail sales state. It also references, there are other questions here. It references whether it's a previous 12 months, prior calendar year, current calendar year. So I think that'll be really helpful for you. And there's also on our website a link to a SaaS taxability map. So that'll show the taxability of software as a service in every state. I caution you only from the perspective that Jeff and I, when we talk with clients, one of the main challenges oftentimes is determining what somebody is selling, and it sounds obvious in terms of, oh, we're selling a SaaS solution. Maybe, maybe not. So sometimes there's some nuances to identify, are we really selling SaaS, or is it some type of electronically downloaded software or something different? So if you know you do have a SaaS solution, then our SaaS taxability map will be able to help you out.
So we've got Nexus determination having been made. We've got a clear idea and understanding of where we have to comply. We've kind of gone through the exercise of evaluating our products and services, and in fact, we've determined some of our products and services are taxable in the states in which we have Nexus. And now we get into even another level of complexity, and that is, who are we selling to? And in many states, depending on the entity to which you're selling or providing your products or services, they may be inherently exempt from sales tax. Now, at the federal level, any sale to the federal government is automatically exempt from tax. We cannot impose a tax on the federal government. And while that's a pretty broad and definitive statement, I would caution you that there are other circumstances like New Mexico. New Mexico has a gross receipts tax. And so a gross receipts tax is a little different than a sales tax. We all talk about it, even myself, as a sales tax. I always refer to it as a sales tax. But it is important to note that it is different. And the difference is that we're not necessarily imposing that tax on the customer. And so, in fact, in New Mexico, if you have to do business with the federal government, it's likely not exempt from the gross receipts tax in New Mexico. That's a very rare occurrence. All the other states, we would expect that exemption to apply. Then you get into state and local government, and there's this tendency amongst companies, and I'll probably make this same statement about 3 times. There's a tendency for companies to think, oh, that's state and local government. They're not taxable. They're exempt. Not true in every state. A lot of states do exempt state and local government. Not every state does. The critical determinations of that are, who are you selling to? Who's the buyer of record? It has to be officially the state or local government if they do have an exemption in that state. And then it can't be an employee, rather. And then a lot of times you're going to still have to get some level of documentation to support that exemption, which we'll talk about here in the next slide. Nonprofit organizations. Here again, if I've been operating in a state that exempts nonprofits from sales tax, it's easy for me to just use that same theory and philosophy when I start selling into other states. And the reality is not all states exempt nonprofits. And not only that, you still have to get the exemption certificate, whether or not they're legitimately a nonprofit. Then we get into business types. So those were types of entities, and then we get into types of transactions. And the first one that's the most common, I say the most common, it just feels the most common, would be resellers. So if I'm selling to Walmart and I'm selling a product they're going to put on their shelves, they're not going to pay sales tax to me on the product. They're a reseller. They're the retailer of record. And sales tax is only imposed on a retail sale of tangible personal property and enumerated services. So what's going to happen there is they're going to do something in the way of an exemption certificate or a document that exempts that transaction. Manufacturing, a lot of states incent manufacturing because it creates jobs, creates opportunity. And so their incentives are, I can buy machinery and equipment exempt from sales tax to build my facility and to maintain it. A lot of robust exemptions exist across the board in all states, not all, but virtually all states when it comes to manufacturing. And the last area would be agriculture. A lot of really unique rules when it comes to agriculture. I won't go into any great level of detail other than to tell you this usually, sometimes when I make a comment, it just wakes people up, and that's all I'm doing. I know we're coming to the end, but I was on a call this morning with a company from Denmark. They specialize in the sale of bull semen to farmers, and they do very advanced technology and genetic testing and things like that to perfectly align the right bull specimen with the right cow or breed. and that it just makes for a much better result for the farmer. So there's a lot of weird things out there that go on that sales tax kind of rolls in and rolls out of. The last thing I'm going to talk about before letting Brian close us out, and I never leave Brian enough time. He always slaps me around at the end of each presentation. I make him have to rapidly get through. But in relation to the taxability of special entities, I wanted to talk just briefly and lastly about exemptions versus exclusions. And the difference is this: an exemption is where the product or the service being provided is otherwise subject to sales tax in that state, but for the use of the product or the type of entity I'm selling it to. So if we just take a chair is always subject to sales tax, except when I sell it to Walmart and they're going to put it on their shelf to resell to a customer, except when I sell it to the federal government. So those are the exceptions. And when you have exceptions, generally speaking, you're going to need some level of documentation from that customer to substantiate that they're using it in that capacity. The only exception to that rule is the federal government. If your invoice is directly to the federal government, that serves as evidence that you don't need a certificate. Everyone else needs a certificate. Nonprofits, agriculture, manufacturing, they've got to give you some evidence that they qualify as exempt before you can exempt that transaction. Exclusions are those things we described earlier as professional services. And what that really says is that they're excluded from the statutes. There's nothing in the statutes that references their taxability. So in the absence of taxing something, it's excluded from tax. And when something's excluded from tax, you don't need any documentation for it. It's just statutorily not taxable. So generally the services we provide here at TaxConnex, in the state of Georgia at least, are excluded from sales tax. So we don't have to issue resale certificates for anything we buy in terms of services that we might resell. If we buy computers, however, we got to pay sales tax on those computers. So just some perspective on exemptions versus exclusions, and that it's very important to get exemption certificates when necessary.
Sounds great. Okay, so this is like speed round, Jeff, speed dating here. So this first question, let's assume that there's not a physical presence in the state, so we're dealing with economic presence. And James asks, do you have to register and collect at the time your cumulative sales in a year hits the threshold, or do you begin collecting in the subsequent year? If the requirement is immediate, how do you collect sales tax on the sales prior to reaching the threshold?
Yeah, there's kind of two pieces to that. One, you don't have to worry about collecting tax on the sales prior to reaching the threshold, so you don't need to worry about that. Second answer to your question is it depends. We've got a whole series outside of this webinar on that terminology, it depends. But every state's a little bit different. Some states will just classify your threshold as being met in the prior calendar year, so that in the following year, that's when you have to register and start charging tax. Sometimes it's when your transactions or your threshold of revenue has exceeded the threshold, and you immediately need to start charging tax on the next dollar that you sell or next invoice that you sell. And then there are some states that give you some grace periods, which is really logical. It makes a lot more sense. And that is give you 60 to 90 days to get registered and to start charging tax. So you can still have a little bit of grace. You can exceed the threshold and even have more transactions before you need to register. So it just depends on the state. It's not a clear answer, I know, but don't worry about the sales up to the threshold.
Perfect. And in a scenario, this is from Wendy. So Wendy asks, once you eclipse that economic threshold and you realize you've got to register and start complying at that point, do you have to collect and remit sales tax previously? I think you just answered no if that's the only nexus that we have, if there's no physical presence. All right, perfect. I initially read that one a different way and was thinking that there was a separate question related to that. And I'm just scrolling through the questions here. So you've got nexus, whether it's physical or economic, but that state is not taxable for what you sell. So you're in California, got a physical presence, you're selling
SaaS.
Not taxable, what do you do?
You don't need to worry about sales tax. You don't need to register. You have no compliance requirement whatsoever for sales tax purposes if that's the only thing you sell. You're excluded from the tax law.
All right, just scrolling through here. There's a question about, is shipping included or excluded? I think what we're talking about is back to the gross sales measure for economic nexus purposes. Do we include the shipping costs as part of that gross sale?
I would say yes. Just generally speaking, yes.
And sales tax would be excluded from that gross sale?
Well, presumably you wouldn't have sales tax on your invoice to be able to include it.
Because you
wouldn't be registered.
Good point. All right, I'll keep going here. Another gross receipts question. What happens when you have returns? So
that's a
originally you sell $105,000 and you had $10,000 return. What do you do?
If the return happened a few months later after you had met the threshold, since we're at the end of this meeting, I hope I'm not being recorded, but you're screwed. You're going to have created Nexus. Now, the reality is, and it's a good question, by the way, the reality is that if you didn't take action when you exceeded the threshold and you subsequently did, in fact, have that return, you're protected. You should be protected. There surely shouldn't be any assertion of Nexus by the states. I haven't seen that exact example under these conditions and in relation to your question, but my gut tells me that's not going to be an issue if you forgot to register or ignored the registration requirement, but then could validate that, in fact, you didn't meet the threshold.
This has been It Depends, with another episode explaining the complexities surrounding sales and use tax. We'll see you next time.